Good morning. Thank you for joining Marsh Captive Solutions today for our 2022 Captive Landscape webinar. My name is Christine Michael and I'm the VP of Marketing, and I'm your host today. You are in listen and view only mode. If you have questions for the panelists, please enter them into the Q&A box. We'll do our best to answer them at the end of the session during the live Q&A. If we're unable to do so, we will be sure to follow up with you after the webinar. The replay and the slides will be made available to all attendees. Now I'd like to introduce you to Ellen Charnley, the president of Marsh Captive Solutions. She'll be moderating today's session. Here you go, Ellen.
Thanks very much, Christine. And wow, welcome everybody to today's amazing webinar. We have over 1,000 people joining us today. I think that's a world record in Captive Solutions webinars, and we're thrilled to have every single one of you with us today. Oh my, do we have a lot to try and unpack for you today. This is the first webinar we have done for some time. And we normally do this at RIMS, as some of you may recall. This past RIMS in San Francisco, we didn't do this for you. We were a little tight on time and resources at RIMS, so instead we're doing this for you as a webinar. If you want us to do it at RIMS in Atlanta next year, drop us a line and let us know. We'd love to have your feedback. We prefer a live session, but we're always open-minded and would love your feedback. But anyway, we're going to do the best we can by webinar. Do please use the Q&A section on the Zoom and let us have any questions that you may have. Today's webinar is all about the growth of what we've experienced in the last 2 years, and boy, have we experienced a growth. We're going to give you an overview of the captive landscape as we see it at Marsh Captive Solutions. We're going to talk about the challenging market as everybody has experienced it all across the globe. And we're going to talk about that growth, really unpack it, what it's meant for captives in every possible corner of the landscape. We've got a whole bunch of slides and I'm in charge of the deck. So I may have some technical issues here. So do please bear with me. As you can tell, I've got some wonderful people with me here today, and together we've got probably about a gazillion years of captive experience. I haven't bothered adding it up because I think honestly I would lose count, but together we are, though I say so myself in a very cocky way, pretty experienced in captives. In no particular order, I've got Art Krasinski, who's our product innovation leader, very sexy title. I've got Lorraine Stack, our international sales and advisory leader, head of consulting international. And I've got Mike Siricchio, our head of America's consulting and sales as well. Together, there's probably not a single question that we don't know the answer to, but please go ahead and challenge us. We'd love a nice hard question as we get going. So thank you to my trusty panelists who often join me on this wonderful webinar. We're very excited to get going and chat with you all on today's wonderful topic of captive landscape and in particular growth. So without further ado, wow, I'd like to kick off and talk about this wonderful growth that we have experienced. And on the screen here today, you can see that massive number of 1,500 captives. That's what we manage here at Marsh Captive Solutions across the globe, across something like 52 domiciles, I think at the last count, across the globe. And that totals $68 billion in premium. Now, over the last 2 years, we've been monitoring this. That's an increase of 200 captives. That's more growth than I've ever seen in my captive life. And I've been in this for, as I would say, donkey's years, as my co-panelists have been also. And that accounts for an increase in, the 200 captives accounts for an increase in $3.4 billion in premiums in those new formations. It's been mind-boggling. I've never seen anything like it. It's caused its challenges for us in a good way because the phone's been ringing off the hook, and the emails have been clogging up the inbox. But let me stop speaking and just hand it over to my panelists and let them just give some overriding and initial thoughts about about the growth. And maybe Art, you can kick off. What's it been like for you?
Well, Ellen, the headline says it all. It really is historic growth in captive use. I was around. This is comparable to the 1980s hard market, where there was no liability insurance for corporate clients. And frankly, as a result of that, there was a lot of group captive formations, including ACE and Excel, which went from being the solution to now being the problem. But the historic growth is evidenced by 200 captives a year. We used to form 100 captives a year, and we thought we were busy. What's interesting to note, though, is that the captives are a trailing indicator of a hard market, meaning that the hard market will start, and it'll take about a year for everyone to figure out that the captive very well may be a solution. So while insurance rates are starting to slow the increase, we haven't seen any decrease in the number of captives. So that's my 2 cents on this historic growth headline.
Yeah, that's exactly right. Lorraine, what about you? I mean, you have an international lens outside of the US. What's been going on in your world?
Oh, it's been busy. It's been so busy. Honestly, busiest period ever in captive consulting. I mean, we've added resources to our consulting teams around the world to cope with demand. A couple of observations from me during this phase would be, well, firstly, how prevalent captives are now in the risk management kind of consciousness. Everyone knows what a captive is. They may not know the detail, but they're certainly aware of them. And the secondly thing would be the profile of companies that are coming to us now are different. It's smaller companies, it's not multinationals that would have really been users of captives in the past, certainly not at the international side. And so what we've got here is a brand new generation of captive owners, and they're driving us towards being more innovative and driving us in different directions. So it's really exciting. It's a great time.
Yeah, that's awesome. It's awesome. I'm going to come back to you on a question there. It's just prompted me to think of something else. But Mike, what about your initial thoughts?
Sure, Ellen. So I always like to look at premium, and if you use premium for our book of business, this is just one captive manager's book of business. If you use premium as a proxy, $68 billion in total premium. That is larger than the largest P&C carrier in the world, which is Allianz, by about $6 billion. So it just shows you that the volume of premium running through captives is just immense. And the surplus running through captives is almost double what it is for the largest P&C carrier in the world. So we've got about $119 billion worth of surplus going through our captives, which allows clients to do, captive owners to do impressive, innovative things now and also into the future. And I think that's where, in the next few years, you're going to find clients taking on a lot more risk because they've got the wherewithal to do it. So premium is huge, and it is much larger than even the largest carrier in the world.
Yeah, that's a shocking statistic in a very interesting way. Lorraine, just let me go back to, you talked about smaller companies, a whole new market, really. And we're focusing this webinar really with an expectation that people really understand quite a lot about captives coming into it. But given the number of people who've dialed into this webinar, I just want to level set a little bit. What happens if people are dialing in and really have no idea what we're talking about? Can you just dial it down for some people who really would like some very, very high level basics for us? What are we talking about here about captives?
So great question. So captives essentially they're a risk financing mechanism in which a company insures itself against its own future losses. So at a very basic level, it assumes that you're comfortable taking risk. So that's sort of the first question, that you need to sort of ask yourself in terms of, are we ready? Should we be considering a captive? There are other indicators. Are you frustrated with the insurance market? Well, I suppose that's universal potentially. Are deductibles and retentions, are you being forced to take more risk by insurers effectively? Are your business units struggling with that risk retention? You at a group level, you may be comfortable with retaining more risk, but might be difficult to push it down to subsidiaries. Is capacity shrinking in your industry? Honestly, there are a number of indications, and then there are other indications about scale, because it takes there's costs involved with running captives. And so you need a certain amount of scale in order to make it economically viable. Now, I would group inquiries on my desk at the moment into two. Those companies that are looking to reduce costs over a number of different lines, reduce total insurance cost and limit viability or volatility, I mean. Mm-hmm. And those that are actually having trouble finding insurance for a particular line of insurance line. So those who are looking to reduce costs tend to look at a feasibility study where we kind of look at where, what kind of risks to retain. We look at their entire risk portfolio. So those companies, the minimum in terms of scale. In Europe, you guys may have a different view in the US, but in Europe, you need a premium of at least 2 to 3 million to start for a captive to make sense, less potentially for a protected cell. If you have trouble, if you need to provide insurance that the insurers are not providing and you need to form a captive for that, that's a different thing altogether. And an example of that would be professional indemnity in the UK. We don't need to do a feasibility study to know you can't, you need evidence of insurance, and a captive could potentially help you provide that. So those are some. I will plug at this stage the definitive captive guide, which we will make available as well to people who've joined up to this webinar afterwards. So that sort of covers a lot of these questions.
Awesome. I think we got a good overview and some good basics covered there as well. But staying with you, Lorraine, let's move on to this wonderful slide here, which is a little complicated, but let's unpack it here. It shows our insurance market pricing indices and the changes really in the last few years, and showing how they've changed and the pricing indices have changed and compared with the gross written premium of our captives. So tell us what this is showing, Lorraine.
Right, so the green bars with the percentages in them, what that is showing the variance in commercial insurance pricing since 2017. And this is taken from Marsh's Global Insurance Pricing Index. So it's a composite rate. So there's variations globally by geography, and then there'd be variations by coverage forms. The blue overlay on the background with the dollar numbers in it, that identifies the captive premium that is written by all of the captives that we manage globally. That's 1,500 captives, not just the 200 that we formed and that we're speaking about in detail today. So what you're seeing there is in 2019 that's really where the challenging market started to really take hold. And you can see a steep increase in the premium written within captives. So between when the challenging market started and the end of Q4 2021, there was almost a 40% increase in premium written within captives. Now that's new captive formations and then existing captives writing more coverage. Now the pricing increases are starting to moderate. You can see that in Q4 2021, and that trend continued into 2022, where the Q2 2022 increase is 9%. Now there's some insurance lines that are booking this trend. Cyber in particular is way above that. But this sort of shows the direction of travel. And, while rates are moderating, as Art has said, there'll still be a tail with us. We've got a huge pipeline of inquiries and feasibility studies still out there. And what other things that we should be considering is, the uncertainty that's out there, inflation, right? Asset values, claims values are increasing, which is really threatening insurer profitability. That means, higher rates, and insureds will essentially be forced to take more risk. And so with all that uncertainty out there, we've got conflict in Europe, we've got continuing supply chain issues, on top of 3 years of price increases. So we definitely expect premium to grow further, and that's 68 billion to be higher next year.
Okay, good prediction. We'll we won't hold you to it, but that would be awesome. Okay, we had a question that came in, and I think I would like to pass it to either Mike or Art. And if I read it, it was, do we feel that the growth, this unprecedented growth will increase the scrutiny of the IRS, and how do we feel that potentially could impact captives? Maybe either Mike or Art could have a go at answering that.
I'll take a crack and then I'll turn it over to Art. But
Yeah.
the IRS audits for captives are very routine. They're not going to explode for, very historic older captives that are doing, appropriate things. Is the historic growth coupled with the new law in the United States that's going to add a whole bunch of IRS agents going to cause a little bit of buzz? Probably. Are small micro captives going to get audited like they are like they have been in the last few years? Absolutely. But a well-structured, prudent, large captive doing the right thing with good capital base, good premium, good business purpose is probably going to go through an audit just like they would have with their parent company, and they're going to come out with probably no changes. Are there going to be some issues in the middle to deal with? Probably, but that's just the nature of big growth and big growth with the IRS. So Art, maybe I'll turn it over to you to see what your perspectives are.
The one comment you had about making sure your captive is properly structured, we can't emphasize that enough. And if there's anything that the industry can pick up from the last few years of audits and some very public cases, is everything not to do. So make sure that when there's a comment about having appropriate capital and the actuary setting premiums, and making sure that everything is properly funded, those are lessons that unfortunately many captive owners have learned the hard way, and take the advice, frankly, that you will get from your captive manager and from your tax advisor in terms of doing things the right way, and audits won't be a concern then.
Awesome. Thank you very much, both of you. And the questions are coming in thick and fast, so we'll do our best to continue to answer them as we move forward. I'm going to move forward again, and we're going to start to unpack this growth a little bit in more detail. And we've got a lot to unpack on this slide. Maybe looks like it also. And I'm going to ask Mike to help us out here. So what this slide is doing, it's talking specifically about non-traditional lines of coverage. Some of these lines here, you're not necessarily would expect to talk about with captives. But we're seeing quite a lot of interest in captive usage in this growth area. Mike, tell us a little bit what's been going on with the growth in that 200 that we saw earlier.
Absolutely. And again, that 200. So this is the newest hot off the press statistics of what they're doing. And I love it because it's all your non-traditional. It's all of your outside the box innovative. So we've got third-party business. Those 200 captives, 10% of them did some sort of third party. That's sharing economy, gig, tenant risks, extended service contracts, extended warranties, automakers of showing different products on their cars. Even MGAs or managing general agencies and insurtech startups that are doing everything from cyber to property insurance, doing it with their secret sauce and using captives to reinsure some of that risk. You also saw terrorism, which is very prevalent in the world today. You saw things like TRIA and various terrorism pools globally. Medical stop loss, which is a quasi-employee benefit coverage that is more akin to the corporation's medical stop loss on their own employees. But we saw that going through captives and accessing reinsurance to the tune of 6%, which actually gives real dollar savings overnight. And it's a really great way to start a captive. And we've seen a lot of captives start, a lot of sell captives, which we're going to talk a little bit about later. Everybody's mind is on cyber, and cyber liability 20 years ago, was not in captives. And now we see that 4% of our captives are writing some degree of cyber, whether that's a quota share or a high excess, cyber terrorism, or even a deductible. We're seeing that clients are starting captives for the first time to insure cyber in their captive, which normally would have been an additive kind of coverage, but now we're seeing that companies are actually putting it in to start their captive. Business interruption, we saw that through the pandemic. Contingent business interruption, BI, related to various property damage risks, but also contingent business risks. Again, 4%. And lastly, D&O, which is going to, shock many. There's been a Delaware law that Art's going to talk a little bit about later that allows Side A D&O to be written in Delaware captives. And there's a lot of buzz in the market. We've seen huge rate increases on D&O. We've seen huge rate increases on cyber. And a viable captive, either an existing one or a new one, is really there to help plug the gaps, fill the holes, and do some really creative things for clients. And that's why this historic growth is just amazing. And one of my predictions is that, you know, in the next few years, even if as the market does soften, you may find these clients, these large companies, these middle market companies saying, well, I have the wherewithal to take these risks, so I'm going to keep them in my captive. I'm going to take a higher retention. Maybe I'm going to buy a little bit less insurance and kind of go excess. And these are all the things that all of these lines of coverage on this slide show you that clients are doing actively, and they're going to continue to do.
Awesome. Thanks, Mike. Before I ask Art about the Delaware D&O law, quick question on the MGAs. There seems to be a lot of activity for MGA and insurtech firms starting captives. Why is that?
Yeah, so in MGA insurtechs, and insurtechs is a buzzword, and InsurTech Connect is coming up next month, and MMC will have a large presence at. But MGA insurtechs, they know their business so well, they know their algorithms so well, they've done so much to kind of drive the lower costs, the more capacity, and the smarter way of insurance. But they've got to work with fronting carriers. They've got to work with commercial carriers. And one of the things that MGAs do very well is they raise money, they build their program, and the next thing they do is think about a captive, because a captive is one of the only vehicles that can reinsure a fronting carrier and allow that MGA, startup, insurtech business, whatever it might be, property, work comp, flood, whatever the case may be, cyber even, to have a vehicle to take some of the profitable risk, but also to get more access to more markets, to work better with reinsurers. And that captive vehicle is the silver bullet that allows them to do that. And it's one of my most exciting areas right now, because it's really growing. And we're finding that a lot of the third-party business that we're seeing is coming from insurtechs and MGAs, and they really need it for capacity reasons and actually just taking on a little bit more profit and having some skin in the game. So those are the reasons why you're seeing so many MGA insurtechs using captives.
Awesome. And a whole different market segment that we hadn't seen in prior years. It's a very exciting one. Another question, excuse me, which ties nicely with the D&O side of things, came in saying, is the D&O cover essentially for Delaware domicile captives only? Art, that's teed up perfectly for you. Tell us a little bit about this new law that's come in.
Sure. D&O has always been one of those miscellaneous coverages. As you go through retentions, you might have put in your side B and C deductible into a captive. In the last few years, though, we've seen a lot more activity. Prior to this new Delaware law change, which I'll get into in a second, companies that couldn't get D&O at all, or were paying significantly, high rates online, let's say 25 to 50% rate online, we're starting to form captives and use cells in Bermuda to create more D&O capacity. So that there was some activity starting, and think of companies like crypto companies where D&O is hard to come by, if they can come by it at all, as well as cannabis companies and other distressed organizations. We're starting to create captives. Delaware this year, out of nowhere, changed not their captive law, but their corporate law to allow captives to write Side A cover. And Side A, for those of you that aren't familiar with D&O, basically indemnifies directors for acts that the corporation itself isn't allowed to indemnify. So there's a circularity aspect, which is why Side A was never put in captives. The Delaware law clarified it and now permits it. You do not necessarily have to have a Delaware captive to provide D&O for a Delaware incorporated company. On the other hand, if you do, we think there's one less potential problem with corporate laws of one state being different from corporate laws in Delaware. So the thought is that you can have kind of one less uncertainty by having a Delaware captive if your home based company is incorporated in Delaware.
All right, thank you. That's awesome. Okay, well, we've still got a lot of slides to go, so I'm going to move on. Okay, and we're going to talk a little bit more about the traditional risks because they were still being put into the captives that we saw in those first 200. So Mike, tell us a little bit about what we saw in the traditional risks.
Sure. So it's a little bit about what's old is new and back to basics. So when the challenge market hit, property, excess liability, some of those core coverages were really, really challenged. And especially in 2020, when we were hunkered down during the pandemic, we were having call after call on property. And what can I do? How can I get more capacity? Retentions are going up. And this 36% of our new captives is up almost 10 points over what it would have been 3 or 4 years ago. So that just shows you that property, the coverage that's usually number one for the last 50 years, has actually grown. And it's interesting to show that captives have really done what they were supposed to do. They took some premium out of the market, they added capacity, they really plugged some holes. And the captives that we formed and the captives that we've seen doing property really gave back to the parent companies like they should have. So I think it's an amazing kind of testament to the industry, similar to casualty. So, property casualty, AL, GL, workers' comp, employers' liability, excess liability also grew from what we would have seen generally, to the tune of clients forming captives to fill those holes and really go back to the basics of property and casualty coverages and captives. Now, on the professional liability and the med mal side of things, a lot of that has to do with that growth was up as well. And a lot of that has to do with social inflation, like we've all seen and experienced. So it's sort of like the perfect storm of challenge markets, social inflation. The captives that have been around are doing more. The new captives that are being built are kind of plugging those holes. So if you add together this slide, which is the traditional lines, plus the non-traditional, it gives you a nice blend of kind of, innovation in captives. And again, that is the biggest prediction, that you're going to continue to see core plus more non-traditional, innovative, outside the box coverages and captives in the future.
Yeah, one thing that, excuse me, I've got a frog in my throat, which is always typical for these things. One thing that we wanted to I wanted to clarify is that even though we're talking about the 200, we also saw tremendous growth in the existing captives for the increase in premium that they were writing, right? And adding new lines, increasing the retentions of their existing business as well on top of that. And we haven't even captured that today. So that's also another thing that we have been seeing.
Absolutely. Absolutely.
Okay, let's talk about industry, another top favorite topic. So staying with you, Mike, tell us a little bit about this slide.
Sure. So just to your point, the captives in industries that generally had the largest amount of captives, like financial institutions, which are insurance companies, banks, brokers, professional services, and then those MGAs, they tended to grow their business, but they were also the ones that were forming the newest captives, which shows you that it's not just the Fortune 500, even Fortune 1000 that formed captives. It was your more middle market or small regional banks or small insurance companies. We worked with a lot of life companies, a lot of mutuals over the last few years that have done more to form new captives. Healthcare obviously came to the table and said, obviously that has always been the number 2 industry after FIs, but they also grew their industry as well. And to your point about the medium or larger size captives that were existing that grew their book of business, we absolutely saw that in our statistics and our benchmarking, that they actually took on more risk. They did what they were supposed to do. And then even automotive and transportation, which were industries that were challenged during the pandemic, grew their captives as well. So you saw coverages like professional liability and E&O, you saw med mal, you saw medical stop loss, but you also saw some of those core P&C coverages that I talked about in the last slide. And these are all things that are blended through different industries. And if you think about, many industries are completely different from one another, but they tend to have some of the same risks. And that's why you're seeing some of those P&C, E&O, cyber. They have employees, medical stop loss, D&O for the board, and those are things that we're going to continue to see.
Very, very good. Okay, let's talk about captive structures. And this one kind of blew my mind a little bit. Art, let's turn over to you and give Mike a break here. Tell us why this is so interesting compared to what we've seen in the past.
Well, a little entry level on what cells are. If you think about a single owner captive, I like to relate it to a single family house on a piece of property, and you have to do all of all the maintenance. You got to cut the grass, fix the roof, paint the place, shovel the snow, as opposed to a protected cell company, which is more like renting an apartment, and all of the take the care of the infrastructure is done by the landlord. So think of a protected cell company as renting a space to put your captive. It is easy to form. I call it plug and play. You make the decision, and within 2 to 4 weeks, you've got it. So you've got better economics because you don't have to have a separate audit, separate actuarial study. There's no board of directors meetings. So the economics significantly, wave towards a cell facility for many types of coverage. And what's also of interest to a lot of risk managers and corporate counsels is it's not a separate entity. So it's not another box on the org chart that is going to, have to go through a lot of compliance and hoops from an entity perspective. On the other hand, with a cell, you get the exact same insurance license that you would get with a single owner captive. So for companies just starting off, for companies doing basic lines of coverage, for companies that are comfortable sharing infrastructure and letting Marsh be more of a manager, cells are the perfect solution.
But why have we seen more growth in cells in the last 200 than we have, say, historically?
Frankly, for all of those reasons, companies, in a hard market don't have a lot of time to consider forming a captive. The typical captive process involved a 3-month plus feasibility study, and then it had to go through management. And by the time you're done, you're at the next renewal. It was the impact of the hard market that are causing people to say, I want a captive and I want it in 60 days because that's when my renewal is. And we don't have time to do a traditional captive.
Yeah, and we have cell facilities pretty much located all across the globe, so we can accommodate parent companies who want a cell facility in Europe or in the US or in the islands. So we're well covered in that regard. And I think our existing ratio was about 8% of all our captives were covered by cells, and that just shows that the growth there is gone up to 18%. So it'd be interesting to see whether that sort of growth in cells continues. And Mike, I think back to the MGA InsurTech, am I right in remembering that a lot of those have started with cells? Is that correct?
I would say that about 90% have started with cells because it's quick, cheap, easy. They're capital light, and the companies that are forming them kind of tip their toe in the water with cells, and then they think about going into a single parent down the road. Yeah, I think so. Okay, this is lovely and colorful, this slide, and I think it's really trying to tell us who is forming captives with respect to the parent company in particular. Talk us through this and try and make it easier for us to understand.
The chart on the left, parent company revenue, simply shows the number of those 200 new formations, what the parent company gross revenue was. And it's interesting to see that almost 40% were for companies with less than $500 million of revenue. So as Lorraine mentioned earlier, she's seeing more smaller entities forming captives in Europe, and I think we're seeing the same thing in the States. The middle chart was a surprise that the number of, frankly, new formations for private companies is significantly larger than what we've seen in the past. And as I think back over the last couple of years, yes, there's always been many more private companies, but what's happening is those private companies are accessing private markets as opposed to public markets. So as a result, we see much larger private companies. Think of how large Uber and Lyft and some of the other tech companies were before they finally went public. They've delayed going public. And hence, a lot of the firms that we see in those new formations are private equity and private equity owned. And the captive, size and premiums this is pretty much we would expect. If it's a new captive, it's going to start small. The expectation is both by clients and regulators is that captives will grow over time. They will put more coverages in. As companies grow, premiums tend to grow. And as Mike mentioned earlier, we've got the impact of inflation and social inflation now increasing premiums. So smaller organizations are starting off with more premium than they would have in the past.
Yeah, that makes a lot of sense. Okay, I'm conscious of time, so we've got a few more slides still to go. And this is the next two slides are always popular slides, and Lorraine's going to help us unpack these. So remember, Lorraine, this is the parent company slide first,
Yeah.
I think, and then the next one is the domicile slide. So tell us where the parents are forming captives.
Right. So next two slides. So this one tells us who is forming captives, where they're located. So as we can see, 60% are North America, and that's not a surprise, right? So because that is reflective of our book. So 60% of our book is made up of US parents. So not a surprise there. Europe is down a little, and I believe that's because in Europe, most European companies will form a captive in and around Europe, and it can take a bit longer to form a captive in Europe. So I think we've got a bit of a lag there. The big area, I think, the big surprise here is Asia Pacific and Australia, and I'm going to combine these. So Asia Pac and Australia are collectively are forming 18% of our new formations. And, historically, that's only combined, they're only 7% of our book. So that's a big increase in parents in Asia Pacific and Australia forming captives. And a lot of that is driven because of challenging market conditions in Australia. The hard market started there a lot earlier than it did around the rest of the world. And then a general increase in sophistication of risk management in Asia and Pacific region. So that's sort of who's forming captives. So maybe if we move on to the next slide, then the questions were always asked. What about domicile?
Favorite question of the world is domicile.
Yeah. So where's everyone forming captives? Right. So look, 51% are being formed in the US. Now that's a very big jump from 3 years ago. So this is 51% of the new 200. So 3 years ago, 38% of new formations were in the US. So what this means is that, back to what we've been saying consistently all the way through, more mid-sized companies are coming to captives. So there's a lot more US captives there, a lot more cells in the US. But US companies are not just forming cells in the US, because remember, it was 60% and now we're looking at 51% actually located in the US. So some of them are creating captives elsewhere. And why are they doing that? Some of them are creating second captives, maybe, for physical assets that they may have in other locations, maybe Europe, where fronting is a pain right now. It's really costly. And maybe, also there are other issues, maybe so warranty covers, there's changing regulation in some jurisdictions that are making companies turn that from a service contract to an insurance contract. So they're looking for a synthetic insurance wrapper around it, where captives come in again. So there's loads of reasons why US multinational would form a captive elsewhere. What else? So Europe, Guernsey and Luxembourg are probably the two most popular locations and domiciles in Europe, and they're seeing loads and loads of activity. Guernsey is a standout, and that's because we have a cell facility in Guernsey that's getting a lot of attention right now because of a fast track approval process by the regulator in Guernsey. So it's really fast, to Art's point about speed to market. That's possible in Guernsey. Singapore, again, great growth driven by Asia Pacific and Australian formations, as I mentioned earlier. Look, it's really important to point out that while these are some regional standouts, for the first time, I think ever, virtually every one of our domiciles is seeing new formations, right? So historically, in other challenging market cycles, you would have seen captive formations in certain regions or being drawn, for certain isolated issues. Now it's just across the board. So growth everywhere, and we expect to see that continue.
Yeah, and I also want to just address another important point. we are located, as I mentioned right at the very beginning, across the globe. And so we are actually domicile neutral in our advice. We recommend the best domicile and the most appropriate domicile for the parent organization, wherever that may be. It doesn't matter to us as an organization. And I would say that companies get very, very, very hung up on where their captive is located. And by and large, it's probably less important to worry about that than other factors about what they should worry about. In my mind, the most important thing to worry about is why you're forming the captive in the first place, and the captive value, the value that the captive is providing. That if we could cut out half the questions that people ask about where the captive is located, and change those to why the captive is being formed, I truly believe there'd be more value being created and more understanding about captives in general. Because by and large, with the exception of one or two idiosyncrasies with respect to fronting or tax, most domiciles are equal out, particularly in the US. There's not that much difference. So just keep that in mind. And again, another plug for the definitive guide to captive insurance. It'll probably tell you a lot more about domiciles in there anyway. Okay, so we're coming to very, very close to the very end of our webinar. We've done our best to answer some of the questions that have come in. We've had floods of questions that have come in, so we will address as many as we can after in writing to all of you. So rest assured, we will do our best to do that. But one of the favorite parts of the remaining bit of the webinar is to ask my trusty panel predictions for the future. We've talked a lot about the growth that we've seen. So what do you see as the next trend in captives for 2023 and beyond? And first of all, I'll start with Lorraine, since we were just talking to you.
Well, Ellen, I'm going to start with something that hasn't been mentioned yet. And I can't believe we've got to the end of a webinar without mentioning this. But employee benefits, it's employee benefits and captives were growing, a lot prior to the pandemic, but things went very quiet because a lot of focus was put on property and casualty. But there's a lot happening in the background behind the scenes with employee benefits. A lot more interest. We've got medical inflation rising. We've got benefits evolving and enhancements in diversity and inclusion. And sort of having a captive is a much better way of delivering those globally. So yeah, I expect to see a lot more noise around employee benefits next year.
All right, Art, what about you?
I want to go back to something that Mike said. You made a comment about there being 68 billion of premium and 100 billion of capital, which is larger than the world's largest insurance company. I think that going forward, we're going to see more risk pooling and aggregation opportunities. If you think about the capital and premium that's in those captives, there's enough to create capacity. And if you take the margin out, there are ways of creating capacity for property liability. It also provides risk diversification for captives that are in a pooling facility, provides some unrelated risk, meaning that it's just not correlated to the one organization, and there may be some tax benefits there. But most importantly, it's going to reduce variability. So the more kind of risk that's in your captive via different lines of coverage, via different entities because of a pooling organization, via third-party business, reduces variability, and then everyone at the organization is going to feel more comfortable with a captive. So I would predict that pooling rises to the surface again in the next few years.
All right. And Mike?
Well, my prediction is my favorite topic, third-party business. It always has been, and it's twofold. So it's digital distribution of customer insurance by non-traditional means, whether that's a power and utility or a retailer selling insurance, but it's also connected to InsurTech, which is also hugely growing, like I've talked about, whether it's a startup for a different line of coverage, but doing it in a different disruptive way. And I know it's going to grow because I've seen it in the last year, and I know it's coming. So that's my prediction.
That was a dead cert then, really, wasn't it? Not much of a risk. Mine's a bit of a dead cert too, and I've got a slide on it afterwards, so it's a bit of a tee up. And mine's everything connected with ESG. I'm passionate about the subject, and I've already seen it coming. And we at Marsh Captive Solutions are already working on captive specific solutions related to environmental, social, and governance. ESG. Wait for it here. It's coming. It's going to hit us like a snowstorm. I promise you that. And with that, I'm going to move quickly onto the last slide, which we've actually run out of time, but you will get copies of this slide. But we've actually put it here for you, and you can see just a couple of things on the slide of how captives can play a very, very important part of all things E, S, and G. And I'll just leave you with this one comment. If you think about the very existence of a captive, it's a formalized mechanism for funding risks that the organization has decided to self-insure in a formalized entity that's regulated by a licensed, with a licensed insurance, a captive insurance license by a captive regulator. What more governance could there be than that? That in its very nature is G. So I'll leave you with that thought. Thank you very, very much for joining us. We very much appreciate your support. We look forward to hopefully seeing you all at RIMS next year and doing a live version of this. We welcome any feedback that you have. Thank you very much and enjoy the rest of your day.